Have you ever looked at a company's financial statement, seen a massive profit, and then scratched your head wondering why their tax bill seems, well, kind of small? It's a super common question, and the answer isn't some shady, secret loophole. Nope, it's all about accounting. So today, we're going to pull back the curtain on IAS 12, the accounting standard that explains everything. Okay, so here's our game plan. We'll start with that big corporate tax puzzle. Then we'll get into how companies are kind of working with two different profit numbers. After that, we'll see how they bridge the gap between them, and this is the cool part, how today's business creates taxes for tomorrow. And finally, we'll tie it all together to see why this is so critical for anyone who really wants to understand a business. All right, first up, let's really frame the core problem we're trying to solve here, because at the heart of all this tax accounting stuff is one big question that can trip up just about anyone. And here it is, the big one. Why doesn't the tax expense you see on a profit and loss statement match the actual cold hard cash a company pays in taxes? This one question, you guys, is the key to unlocking this entire topic. And the answer, in a nutshell, is that a company is basically playing by two different rule books at the same time. You've got one set of rules for showing investors how the business is really doing, economically speaking, and then you've got another set of rules from the government for figuring out the actual tax bill. So does that mean companies are keeping two totally separate sets of books? Well, not exactly. But what they are doing is calculating two very different profit figures, and each one has a very specific job. Let's break them down. First up, you've got accounting profit. Now, this is the number that a company shouts from the rooftops. It's what they report to shareholders and the public. Its whole purpose is to give you the truest possible picture of the company's economic performance in a given period, and it follows international accounting standards. And then we have taxable profit. This is the number that the tax authorities are really interested in. Why? Because this is the figure that's calculated using their rules, and it's what determines the actual cash tax the company has to pay. This chart just lays it out perfectly, doesn't it? On one side, accounting profit is all about showing true economic performance. On the other, taxable profit is purely about following the government's tax code. It's the same company, same business operations, but two completely different goals, which means two different profit numbers. So, okay, if we have these two different profit numbers, how in the world do accountants connect them? Well, there's a bridge between them, and it's a really key concept called temporary differences. These are what we call temporary differences, and they're exactly what they sound like. They're the difference between how much an asset is worth on the company's own books, that's its carrying amount, and what it's worth for tax purposes, its tax base. And the key word here is temporary. These aren't permanent gaps. They're all about timing, and eventually they'll reverse. Let's walk through a super classic example. So a company buys a machine. The government, wanting to encourage investment, says, hey, you can write off a huge chunk of that value right away, let's say 90. But for its own financial reports, the company uses a slower, more realistic depreciation of 50. See the gap? Suddenly, the machine's value on the books is 100, but for the tax man, it's only 60. That 40 difference, that is our temporary difference right there. So what happens with that 40? Does it just sit there? Absolutely not. That temporary difference isn't just some boring accounting entry. It actually creates a real future tax event that the company has to deal with right now. And this gives rise to something called a deferred tax liability. The easiest way to think about this is the company got a bigger tax break today than what it showed in its accounting profit. But the tax man will eventually come knocking for that money. It's basically a tax bill that's been kicked down the road, a payment that's been postponed. And the math is actually pretty simple. You take that temporary difference of 40 from our machine example, you multiply it by whatever the tax rate is, we'll say 25% here, and boom, you get a deferred tax liability of 10. The company has to put that 10 on its balance sheet today as a little note to the world that it owes this tax in the future. But hang on, because this can totally work the other way too. Sometimes, a company actually pays more tax now than its accounting profit would suggest. And when that happens, it creates a deferred tax asset. You can think of this as a tax prepayment. It's a future tax saving that's just sitting there waiting to be used. A perfect example is something like a product warranty. A company knows it's going to have to pay out for future warranty claims, so it sets aside, say, 100 today, which reduces its accounting profit. But the tax rules are strict. They say you can only claim that deduction when you actually pay the claim. This creates a 100 temporary difference. You hit that with a 25% tax rate, and you've got a 25 deferred tax asset, a future tax break ready and waiting. Okay, so we've gone through assets, liabilities, temporary differences. After all this accounting talk, why should anyone who's not an accountant actually care? Why does any of this matter to you as an investor, an employee, or just someone curious about business? Because understanding all this stuff, understanding deferred taxes, gives you a way clearer, much more honest picture of a company's real financial health. It's like a window into the future, showing you cash obligations or savings that you just can't see anywhere else on the financial statements. So let's just boil it all down. These deferred taxes, they have a direct impact on a company's bottom line, their net income. They shine a bright light on future cash payments or savings. You better believe that professional analysts use this to figure out how real a company's earnings are. And most importantly, it solves our original puzzle by explaining that gap between the tax expense number and the actual cash going to the government. So the next time you crack open a financial report and you see that gap between the profit a company reports and the taxes it paid, you won't just see a number anymore. You'll see the story behind it. A story about equipment, about future promises, and about the huge difference between talking to investors and talking to the tax man. So the real question is, what are you going to look for first?